Hey guys, this is the market update. In this video, some incredible data. If you're a crypto investor, look at this. This is data going back to the 1950s that shows us where the stock market bottoms in comparison to where the economy bottoms. This is amazing data that we can use to try and see where we're going to go over the next 6 months. Remember, we're seeing economic data tip down right now, especially with Google, Microsoft, Apple coming out, missing their targets. And so that doesn't mean necessarily that the stock market has further to go. We'll look at that in this video. We'll also look at the potential scenario for Bitcoin and crypto, considering they did have a rally this week. How is that going to affect us going forward? So I'll leave timestamps for everything down in the description below. Firstly, with Bitcoin, as you can see here, we are definitely trying to break out of an extremely long trend. Both this long trend, which is this line down here, we did break out of it and we got a little bounce. And then this shorter term downtrend here, we've also broken out of that. I think this is about time for a nice healthy pullback here. But to be honest, with the way things are going, I'm really not that bearish anymore. And I'll explain that in this video. But for the most part, I don't think we're going to the moon, but I am comfortable, like I said in previous videos, I am comfortable with the market for crypto right now as it stands, and I'll explain that throughout this video. Before we get into this data right here, if you want to trade on Bybit, link in description. If you trade crypto futures, they'll give you up to $4,000 as a deposit bonus. They're also doing free spot trading on the platform, so check that link out in the description. We can come to this data then, which shows us how the stock market bottoms way before the economy. Now, like I said, Google or Alphabet, Microsoft, Apple, all came out with their earnings this week showing revenue miss and profits miss. So now we're getting into the catastrophe and the disaster of earnings, right? But what you can see from this is that the stock market bottoms before all of that data is at its worst. And we can see this back to the 1950s. So what we can see here, and remember, every recession is not the same, but we can look at this data and it plays out every single time, right? So what we can see here is that the S&P, and we can use this for crypto as well, the S&P in the 50s, it bottomed right here before, about 6 months before, all of the economic data became worse. Now, as you can see here, GDP in gold, that actually starts going up before the payrolls data, which actually takes longer to start coming up, and before earnings data, which seems to take the longest. Now, what we can read from this is that even though stocks could be coming out with ever worse results, it doesn't necessarily mean that we go further and further and further down. What we can see here is a bounce in the stock market before all of those bottom. Now, obviously, that timing is difficult, right? We don't know where we are in this cycle. Remember, we got like a dip here, a little recovery, then a dip, recovery, dip, and then off to the races, right? But you can see this from all of the different recessions right here. So the stagflation era, I'm going to skip because I don't think we've got that. But as you can see here as well, the GDP, payrolls, and earnings of companies all bottom after the stock market rallies, right? So what causes the stock market to rally? Well, it's probably the Fed each time, right? The Fed changing its policy, saying we now need to stimulate the economy. So we can see this here, that even though we're getting earnings disasters from stocks, we don't know where we are in this scenario, but we know that the market will go to the upside before the economic data shows that it's starting to get better. You can see this down in the global financial crisis as well. It's a bit more compressed. But you can see here, the earnings of companies, payrolls, they get way worse for a much longer time than the stock market starts to recover. And so as we know, the stock market reacts to what the Fed is doing and trying to force us to do, and that has a lag. So as the economic data gets worse, it does not mean that stocks and crypto just continue going down. And so this is definitely something to look at, where we know that around 6 months or so, we don't know the timing, right? But for most recessions, it's around 6+ months, right? Before the economic data starts to potentially turn, it's going to get worse and worse and worse. The stock market potentially is going to rally before that. So now we have to look forward and say, what's the Fed doing? Where are they putting interest rates? Are they going to keep being hawkish, or are they going to potentially pause? We're going to look at that now. Next week on the 2nd of November, we get another interest rate hike, but that doesn't matter. It's going to be 75 basis points. that is not the important thing. What the market is pricing in or trying to price in now is the next few meetings and how the Fed is going to react. This is the data right here. So as you can see on the 2nd of November, another 75 basis points. And then in December on the 14th, probably 50 basis points. And then Feb 1st, another 25 basis points. That is what's priced in for the most part now, and that is what the Fed says that they're doing. Now, this can change because if the economic data starts to completely collapse, and we're seeing, inflation figures completely collapse, that's showing us that the recession is probably earlier and possibly more deep. That's going to cause the Fed to start reacting to things, right? So this is what's priced in right now and what the market is expecting. But if the data plays ball in terms of inflation or GDP data coming off, then this could change. Now, it looks like this is going to be pretty much the maximum, and I'll show you this. Remember, this is pricing in. You can see rates getting up to around 4.25%. That's really important because the market right now is at that level. The market was selling off further away from this level, getting even tighter, and the Fed actually last week stepped in, leaked a document through the Financial Times, I think, and said, whoa, don't sell off more because that's more than we actually need. So that's why the market started rallying these past few weeks, is because it almost felt like the Fed called a top for rates, but we can't ever call a top because we don't know what's happening. But if the Fed tell us that that's where they want the top, we have to listen. So that's what the market is pricing in, right? 4.25% right now. And let's see how that goes with inflation. Also, this data right here, as you can see, this is really important. This is inflation data. And according to Fidelity, the head of Fidelity Macro there, the TIPS data is very accurate at pricing in the forward rate of inflation. Now, what you can see right here is that it's actually pricing in a very swift move back to normality. So that is more data, and this has gone through since the 1990s. Essentially, that TIPS data right here, pricing in a very swift move back to normality. This is also something the Fed may look at. Back to normality means, again, no more hawkishness from the Fed. And you can see inflation data, both from CPI and core PCE, looks to have topped and is moving down. This is what the Fed want. And so, the market now is trying to price in a potential, end of all of this scenario. Remember, Bitcoin, crypto, stock market looks 6 to 12 months out. And so in 6 to 12 months, conditions are starting to be expected to be much more normalized and much more easy than they are now. And so that's why we're looking at, in my opinion, a really good time to potentially start getting in dollar cost averaging, much less risk to the downside for Bitcoin, in my opinion. What we can never tell is if there is going to be one final whoosh down as we get a really bad GDP print or, earnings just miss across the board. We can never know if that's going to happen or not. But the only thing we can do with Bitcoin is look at interest rates and potentially interest rates going up further, which, Bitcoin trades off rates. It does have a correlation to the stock market. And so, it's all correlated, right? And so if you have the economy really getting worse, it means that people have less money to invest in Bitcoin and crypto. And so you would expect that correlation to bring Bitcoin and crypto down. But on the flip side, you also have the rate environment, which to me just looks like the Fed don't want it to go any further to the worse for Bitcoin. And so it's very difficult to time this, but it feels like we're in that transition scenario right now. And by the time we're definitely transitioned, you've probably missed like 50% of a move, right? And so that's why dollar cost averaging and getting in these things over the long term is, probably the best way. But if we look at this, why does the Fed come in and say like 4.5 is pretty much the top? As you can see here, these are interest rate payments for the Fed, right? So every dollar you spend on interest rate payments is obviously making the economy worse, right? Because you have less money to spend on everything else and public spending. Interest rate payments are going through the roof, and the Fed have just raised their own mortgage rate, right? They've just raised their own interest rate. You can see here, this is great data from Joe Consorti here. You can see that there is a ton, talking trillions of dollars worth of debt that is about to be rolled over into new debt. You can see that expiring through 2023 for 1.8% is the current interest rate for that debt. What is the current interest rate on treasuries right now? 4.5%. So as you can see here, the Fed doesn't want interest rates to be too high for itself, and it certainly doesn't want them to be too high for too long, despite all of the chatter that they gave the market over the last 12 months. The reason they've raised so high and so fast is because they understand this scenario. Huge amounts of debt that needs to be rolled over, and they want to crush the economy as fast as possible so they can get rates down again to a normalized level. They don't want to be paying 4.5% right here. And so this is why the market looks at this and tends to think, we're going to call your bluff. All of this, we don't know the timing of this, but as you can see, towards the end of next year, mid to end of next year, they're probably not going to want rates to be around 4.5%. They're going to want them materially lower, which means that towards that point, and the flip for the Fed might be around that point. And remember, the rate hike cycle looks to be finishing around February, March next year, and any pause is obviously good for markets. Cutting is definitely good for Bitcoin. Just a little bit more data here as well. As you can see, it looks like rates in the market are starting to top. You can see that this is interest rates in the market right here, just seemingly coming off their top right here. And remember, every time that rates in the actual market tend to come down, that is before the rate, the federal funds rate, the official rate actually tops. Why that is important is because Bitcoin trades off rates, and if rates are coming down, that is positive for Bitcoin. Not off to the moon, but potentially not too much more downside if we're coming out of this part of the cycle. Rates in the market start to come down before the Fed funds rate. There's still a way to go here, but remember, 75 more basis points next month, next week, and then another 50 brings us up to maybe 4%. You'll see interest rates in the market coming down and potentially the Fed pausing right there. So for me, what all of this is saying is that if we don't get some catastrophic blow up in the financial markets, this for me looks to be where the Fed wants things to be, and we're not going higher. Remember that blue line? I drew that blue line months ago. Check videos previously. We're bouncing off it now. We have to see data coming our way though in terms of inflation, but if inflation starts coming down and GDP starts coming down, earnings start coming down, that doesn't mean necessarily that the stock market continues. We could be in a 3 to 5 month period here of, chop. So very difficult to time, but all of these are becoming way more positive for me in terms of the rate, right? The rate of change is not still way to the upside for rates. It looks like this rate of change is slowing, potentially reversing. That's what I'm seeing in the data right now. No, I don't think we're going to the moon anytime soon, but I'm much more comfortable taking risk positions around this level because I feel like the rate of change is coming towards more taking risk. Anyway, that's looking forward. And again, you saw by that data, these things have a lag between the economy and what risk asset markets are doing. The only downside here is that if the economy really does hit consumers a lot, then they'll have less money to invest in Bitcoin and crypto. And so that's why I don't think we're going to the moon anytime soon. But these levels seem to be pretty robust for me, barring any financial calamity. If you want to trade crypto on Bybit, get the $4,000 deposit bonus in the description. 0 fees on the spot market trading as well right now. So check that link down in the description. I'm James with MoneyZG. Cheers for watching, and I'll see you in the next one.